All right. Thanks, everyone, for joining us today. It promises to be the best podcast you've ever heard, and that's totally a function of this month's Haymaker webinar guest, Darius Dale. As you will soon hear, he is incredibly articulate, but you'll also immediately realize his command of macroeconomic data is so impressive, you might think he's had an AI brain implant, but he really hasn't. That's just the way he is. And Darius's firm is 42 Macro, and it's named that because they have 42 different macro or big picture indicators that they track. And more impressively, I followed Darius's work for years, several years, and his positioning indicators, which, as I understand it, Darius, and you can correct me, are distinct from your economic data crunching techniques, but those have been highly accurate. So he and his firm have done an outstanding job of keeping their clients invested and in some of the best performing asset classes here in recent years. He has also made two great pre-election calls. So I heard a podcast he did late last month with Eric Townsend on Macro Voices, where he was very bullish on U.S. stocks and Bitcoin in the post-election phase when a lot of people were apprehensive that it could have broken in a bearish way. Now, we'll talk about gold. That was one where he was a little bit too optimistic, at least on a near-term basis, but I really want to hear his current thoughts on gold. So Darius, thank you ginormously for being willing to join us in our webinar and share your wisdom and your process with us. So with that, I do want to say one other thing about this soundbite that I picked up on that I think is a good lead-in from your chat with Eric Townsend. And basically you said, and I'm paraphrasing a little bit, but it's pretty close, we are all being boiled alive like frogs in a pot of monetary debasement and financial repression. I mean, that's a disturbing analogy from any credible strategist, but from somebody such as yourself who remains bullish on the U.S. stock market, I was particularly surprised by that. But I thought pretty much all of our viewers understand the concept of monetary debasement, but this idea of financial repression is an important one. And perhaps you can explain that as you get into the rest of your material.
Yeah, David, I appreciate the super kind introduction, my friend. I know you got a lot to cover, so I don't want to waste any too much time with pleasantries. So I'll just start by saying thank you again for the wonderful introduction. If I can throw a quick slide on the screen to sort of set the stage for our discussion today, to sort of give investors a little bit of a sense of how we connect with other investors in terms of supplementing their investment processes with our macro risk management overlay. A lot of what we're going to talk about today, specifically as it relates to some of our fourth turning frameworks, the financial repression and the monetary debasement that we're likely to continue to observe in accelerating fashion over the long term, those are all sort of part of our fundamental research process. We are very unlike most investors. We don't use our fundamental research process to dictate the recommendations and the asset allocation and portfolio construction pivots in our client portfolios. That's all coming from our quantitative risk management signaling process. And so that's our market regime nowcasting process. And then we filter that information through two channels. One, our systematic KISS portfolio construction process for retail investors. And then our discretionary risk management overlay is a factor to leadership tool that we use for buy-side clients. And then everything else we're going to talk about today: growth, inflation, policy, liquidity, monetary debasement, financial repression, the explosive growth of public sector debt that we're likely to continue observing in this fourth turning. All of those are designed to help our clients anticipate the evolution of the market regime so that they can sort of kind of guess or predict the predictors, if you will, with respect to our quantitative risk management signaling. So I want to make sure that's very clear, because we're going to talk about some longer term thematic, macro catalysts today that may or may not have any influence on investor portfolios over a very short to medium term time horizon, which is what most of these podcasts are typically focused on. So, David, is there any sort of places you want to get started, or you sort of let me sort of drive the bus?
Yeah, you drive the bus. I mean, I do, if we can get to the fourth turning at some point, because as you explained, and as I sort of attempted to articulate at the beginning, you've really got kind of this dual approach, one of which is a very systematic one. And those indicators aren't a function of anything like a qualitative analysis, such as a fourth turning regime, but yet they're both important. And so maybe that's kind of a critical thing to talk about, is how do you reconcile those, particularly when you get, say, the macro fourth turning stuff telling you something very different than what your indicators are showing you.
Yeah, 100%. And absolutely. So let's start with the fourth turning. And as we sort of get to those slides, I'll start by saying a lot of what we built there, 42 macro, is really just a function of me observing what our buy side clients were doing best. The guys that wind up, staying in their seats for the longest periods of time, the guys that had the best performance, guys and gals that had the best performance over long periods of time. This is sort of what I've noticed them traditionally doing. This is the process. A lot of what you see from a systematic signaling standpoint is a lot of what I've observed them doing. And then obviously we layer on our fundamental research to, again, help clients build or erode confidence in the evolution of our signals. One of the most important topics that we've talked about over the past year plus, so really since last summer, is the concept that we are, as investors, investing in a fourth turning regime. I don't think we have enough time to sort of go into the nitty gritty on what a fourth turning entails, but for those who may be unfamiliar, it's a sort of it's a economic theory based on generational sort of archetypes that sort of suggests that every length of a long human life or so, right around 80 to 100 years, we have a transitional period of great social upheaval in societies whereby legacy institutions are thrown to the wayside. They're replaced by more community focused institutions, and a lot of times in that process, you typically have a lot of inflation. You typically have a lot of public sector debt growth. You typically have total wars. There's a lot of consistent features of these sort of fourth turning regimes, of which going back to the analysis that my former colleague and one of my mentors, Neil House, performed with this late partner, Bill Strauss, they've identified, I want to say, 5 or 6 historical fourth turnings going backwards into the mid 1400s. So there's a pretty consistent typical pattern of how this stuff has occurred in Anglo-American history, and we are in one of those sort of great upheaval periods now. And obviously that has significant implications if you're a human being living in a fourth turning, very much so, certainly as a new father, but it will also have significant implications as an investor. And so the first thing you have to think about is, okay, if you're in a fourth turning, what does that mean ultimately from the monetary and fiscal policy maker reaction functions, and ultimately how their policies are going to impact the economy? Because ultimately that's where the biggest sort of influences are going to come as it relates to asset markets. So we'll start with the fiscal policy risk. We did a big deep dive study studying, I want to say, about 50 to 60 independent time series spanning data as far back as we can get the data, in most cases, about 200-300 years of data, to identify a couple things. One, is there a sort of consistent direction of travel for the particular indicator in a forward turning, and then also what is that consistent direction of travel? Do we typically see an explosive jump condition in some of these key indicators of the economy, of asset markets, of policy? And the answer is yes, having performed that analysis. So for example, if you think about the fiscal policy risk that investors are likely to observe in a fourth turning, you're talking about explosive growth in sovereign deficits, debts, the size of government, and the cost to finance the deficit. That's the typical pattern that we've observed in these fourth turnings. You can sort of see this here when we show the analysis in time series format and the statistical format. What we found is, so the chart on the left just shows the time series of the particular indicator with data going back to the 1800s with the fourth turning regimes highlighted in red. And then the chart on the right just shows the statistical properties of the time series, and the baseline of first, second, and third turnings. That's the white space in the chart on the left, and the fourth turnings, which is the red space on the chart of the left, looking at the median, max, min, and interquartile ranges. And what we found, one of the most salient takeaways, David, in this analysis we performed, is that we typically see a significant deterioration in the sovereign fiscal balance in fourth turnings. I mean, that's been a consistent pattern, and we're already sort of halfway into this fourth turning with already a significant deterioration in the sovereign fiscal balance, a couple of already. And on the other side of that, what we know is that sovereign debt tends to increase sharply in fourth turnings on the other side of that. And so we are in an era of accelerated public sector debt growth that is likely to be a confluence of a few things. One of those things that we believe is populism. Populism. There's sort of two reasons why sovereign debt grows significantly faster relative to trend in the fourth turning. Number one is populism, and number two is you typically have a complete mobilization of public sector resources, in the climax phase of the fourth turning. Most of the times, it historically has always been total war. I'm hoping that it's not total war. Obviously, nobody should be rooting for those kinds of outcomes, but that's what the data suggests that is likely to take place. So on populism specifically, what we find is that the sort of social contract in America tends to break down late in third turnings, and you typically have it at its most broken point early in the first kind of half of fourth turnings, and that's what we're observing here in this data. The blue line in this chart just shows labor share of national income as divided in terms of employee compensation divided by gross domestic income. We're down at 52% currently in the most recent data point, and that compares to a mean of 56% if you go back and you look at the 1960s all the way through to the early 2000s. And so on the flip side of that, you have corporate profits, which are now 13% of gross domestic income. That compares to a mean of only 9% from the early 1960s through the early 2000s. And so that, it doesn't seem like a lot, but we've had this sort of 400 basis point swing in terms of the mean, or rather, kind of a 400 basis point swing from the mean to the current data in both of these time series. And that doesn't seem like a lot, but on an economy as big as the United States, you're talking about $1.2 trillion per annum of lost income that is essentially going from the household sector as a regressive tax or transfer to the corporate sector. And that's obviously got enough people pissed off, as evidenced by the color of the electoral college map, the likely Republican sweep that we've just observed down in DC. And so,
Darius, may I interject, because you brought up something in your recent podcast that on this topic that was very interesting, and you basically said, where's the effect that over the many decades, the Democratic Party has tended to favor the poor with their let's say their handouts, their populism, their socialism, whereas the Republicans have tended to favor the wealthy or corporate America, and maybe it's that effect that's partially behind this divergence that you're showing. But then you mentioned that Donald Trump basically does populism for the rich and the poor.
Yeah.
And that is, to me, a very important change. And that, some of these inflationary implications of his policies, which the market is only kind of waking up to, particularly the bond market, that seems to be really a pretty cataclysmic shift. So any additional thoughts on that part of it?
100%. I mean, that to me is you are front running the bouncing ball. I mean, so that's exactly it. Now I'll sort of speed up to sort of answer your question. So the answer is yes. We've had historically seen Democrats favor government social benefits as a supplement to household incomes over the past few generations. We've certainly seen Republicans favor lower and lower effective corporate tax rates, and the spread between these two policies is the accumulation of public debt. We have a spending problem in this country. We also have a revenue problem in this country as well. And that's sort of the key takeaway that's one of the key takeaways from our analysis here with respect to the fourth turning, is that you're probably going to have a situation where we force the Fed into the game, into the ball game, in terms of having to essentially monetize U.S. public sector debts and public sector deficits. And ultimately, the Fed's response to that could, in fact, create a very inflationary impulse in the economy. In fact, what we found is that when you go back and you study sort of some of the economic time series in the fourth turning, one of the things we've observed is that CPI tends to be explosive in fourth turning regimes. You typically see a sharp acceleration in inflation in these fourth turning regimes, and I think we're only just getting started in the context of what will the Fed be forced to do in response to what is likely to be an acceleration in public sector debt, an explosive acceleration in public sector debt accumulation. We're anchoring on sort of a forecast from the Committee for Responsible Federal Budget, which we've, through our research, have identified as the most sort of bipartisan think tank down in DC as it relates to fiscal matters. And what we found is that if you sort of add up all the things that President Trump has promised on the campaign trail, you're talking about an additional $7.5 trillion of incremental deficits and debt relative to the baseline. Now, obviously, not everything he's said on the campaign trail is going to turn into law. But even if we haircut that in some significant manner, we're still talking probably about $3.5 to $5 trillion of additional public sector debt that will be added to the U.S. public sector balance sheet. If you took all of his policies at face value, we're talking about a public sector debt to GDP ratio in the United States 10 years from now at about 125%, which is already past the point of no return if you look at some of the data we've observed with Reinhard and Rogoff and subsequent studies. But you're looking at 142% debt to GDP ratio in trailing 10 years time, assuming that full $7.5 trillion hits the tape. So somewhere between 125 and 142, we know that's where the U.S. debt to GDP ratio is probably going to be as a function of this sort of combination of, lax tax policy on the corporate side and on the consumer income side, but also populist fiscal policy on the terms of the personal subsidies. So these, we're kind of, I wouldn't say I don't like to use the words end game or marching past the point of abyss, because the reality is all the stuff will still be going on after all of us dies. So there is no end game. But the reality is that the game is evolving in a way that suggests that the monetary policymaker is going to have to be incrementally forced into this. And that's exactly what we've observed, right? If you go back
Darius, just to be clear, what you were talking about, that $7.5 trillion increase, that's above baseline. That's above roughly a $2 trillion per year annual deficit, correct?
Correct. Absolutely. I mean, our deficit. Let's before I even get back to my other point, we got to talk about this deficit. I mean, this is some of the nuttiest stuff. I mean, I think you probably watched our Around the Horn webcast this weekend if you haven't. This is some of the nuttiest stuff I've ever seen in my career, and I've analyzed respectfully probably more time series than anybody I know, which probably includes everyone now on this call. The U.S. public sector debt deficit is growing in a fully employed economy that's currently growing above trend from a nominal and real GDP perspective at levels that just don't make a ton of sense and very clearly are not sustainable. So let's kind of break down some of the elements of the budget deficit that I think folks need to be aware of. Right, if you look at the budget balance, we're on an annualized nominal calendar year-to-date basis. We're at $1.9 trillion through data through October. If you look at sort of some of the key drivers of the budget deficit, things that I would argue can't be cut, like true interest expense. Our friend Luke Groman over at Forest for the Trees is a good thought leader on some of these topics. He's got this metric called true interest expense, which is Medicare, Social Security, national defense, and obviously net interest on the debt. And true interest expense is about $4.2 trillion. It's about 14% of nominal GDP. It's 61% of total federal expenditures. It's growing at 11% on an annualized calendar year-to-date basis, and that's on top of growth of 17% last year and 11% in 2022. Now, again, we are growing the parts of the budget deficit that probably can't be cut with, won't have any real political will to cut until we get very deep in this forward turning, and we all kind of have to be a lot more thoughtful about how we mobilize public sector resources. But up until that point, we're already on a very unsustainable path from the perspective of these metrics. And the budget deficit.
But Darius, Elon Musk is going to cut the federal deficit by $2 trillion.
Yeah, I mean, look, what is he going to cut? I mean, so if you add up the true interest expense, and then we would argue, just because Donald Trump campaigned on what I would argue to be the most populist platform we've seen since FDR, it's very unlikely they're going to cut any of the things that we just highlighted, or things like Medicaid and welfare and veterans benefits and services, which obviously cater to some of the more lower income segments of society. So when you add true interest expense plus those untouchables, you're talking about $6.1 trillion. That's 90% of the federal budget deficit, the federal expenditures. So if you're talking about, you're essentially saying there's only about $700 billion left of things. If you cut the entire rest of the federal budget balance from the things that we would argue you can't touch based on the promises on the campaign trail, you're talking about cutting about $700 billion. And again, that's cutting every other thing that the federal government does. And so our view is that Elon Musk is full of poop. They're not going to be able to have a significant impact on the federal budget deficit in any real material manner. And certainly we would argue, based on the precondition that we're in a forward turning, there's really no political will to do any of this or make any significant draconian recommendations, to push through any significant draconian recommendations anyway. I mean, you want to go from a red wave to a blue wave, cut $2 trillion from the public sector deficit in the middle of a forward turning. I dare you.
Well, and you brought up Luke Groman, and that's one of his points, is if you really did a draconian cut to federal spending, you would trigger almost immediately a deep recession, which would then blow out the federal deficit. So it's really it's a real predicament, a real conundrum that we're in right now.
Yeah, no, I mean, there will be a day of reckoning where we all realize that this is probably unsustainable, and there will be some significant and some material cuts, and not just to the budget deficit, but to the way we live life and the social contract that we have with the U.S. government. And those are the types of changes, big changes, that tend to occur in forward turnings anyway. So that's coming. We know that's going to come. It's the path that we take to get there as investors that I'm most interested in, and I think is the most relevant for the folks on this call. And so that takes me back into my previous point, which is, historically speaking, the Fed has had a pretty consistent pay. Now, the Fed's only been around for one fourth turning, so let me be very clear about that. We can only source data from the previous fourth turning, because the Fed was introduced in the early 1900s, 1913, I want to say. And so based on the historical patterns that the Fed has, based on the historical policies the Fed has implemented, we can observe a pattern of behavior that sort of winds up in this, kind of the point you made at the beginning of the call, David, which is monetary debasement and financial repression are really the only ways out of this. If you think about this from a game theory perspective, what is the choice the Fed will make that will cause the maximum amount of utility for a system that probably is going to experience a lot of inflation and potentially a tremendous amount of geopolitical consternation anyway? It's monetization and monetary debasement. So if you look at, for example, you look at the real T-bill yield in the previous four turning, got deeply negative and was persistently negative in the previous four turning as the Fed, implemented yield curve control for, I want to say about 10 years up until the early 1950s. In our view, yield curve control is very much a possibility in this fourth turning as we start to see the more onerous impact upon both the economy and asset markets that, very elevated rates of public sector borrowing will have. Right. Don't forget we've had.
Okay, so that's critical, Darius. So that's really where you're talking about financial repression.
Exactly.
Because again, I think a lot of listeners don't know that. They get monetary debasement, but not the financial repression. Yep. So this idea that yields of government debt are held at very low, below inflation levels. And they did that after World War II. You're right. That's how we got out of the huge debt to GDP coming out of World War II. By 1952, I think we'd gone from 120% down to 70%, so about a 50% decline in 7 years. Mm-hmm. But how do you think they'll do it this time?
Yeah, I think it's a combination of things. So one, the sort of three things. If you think about keeping yields artificially low relative to inflation and probably relative to where they would otherwise be in a market-oriented system, we don't think the Treasury market is functioning with true market forces. So that's number one. Number two, obviously, printing the money, monetization, your typical standard monetary debasement that we're all familiar with as investors. And then finally, they'll be using their regulatory function to force, commercial banks and other financial intermediaries like insurance funds, pension funds, further into the Treasury market to kind of fill up the large vacuuming sound left by, other pockets of other cohorts of investors. So I'll start with the regulated financial institution aspect of that, and I'll kind of walk my way backwards from there. You should be expecting a lot of financial repression. You should be expecting banks and other financial institutions to get, sort of incrementally repressed into the Treasury market, because I would argue they're probably underexposed to the Treasury market relative to where they need to be, and certainly relative to where they were in the prior four turning. If you look at commercial banks, for example, their Treasury and agency securities are only 19% of total bank assets. You go back to the previous four turning, it was about 47% at the highs. And so, we got a long way to go up from that perspective. If you look at their Treasury and agency securities outstanding, it's only about 16% of marketable Treasury securities. We were up at 33%, in the early 2000s. These numbers can go much higher and probably will go much higher over the long term. So that's one. On number two would be the monetary debasement that we are likely to see as a function of there's just not enough price insensitive buyers of Treasury securities as there had been in previous cycles. So the Fed, I'm showing you this chart here, just the share of the marketable Treasury market according to different, cohorts of investors. The blue line is the Federal Reserve. Their holdings have not kept pace with the growth of public sector debt. So we're now down at 16% of total. The red line, commercial banks, it's about 15 or 16% of the total. The black line is the foreign central banks, so foreign official reserve sector. That's down now to 14% of the total, having peaked at, roughly about 45% in early 2008. And so, the residual of the sort of all these changes that we've seen over the long term has been the private sector. The global non-bank private sector has had to take on a tremendous amount of the incremental issuance in recent years. And it's only going to get worse in terms of the indigestion we're going to feel as investors, because this has occurred at a time where the federal the reverse repo facility balance on the Fed's balance sheet has gone from about $2 trillion to about $150-something billion currently. So that's allowed Treasury Secretary Yellen to concentrate issuance on the short end of the Treasury curve and really have a very de minimis impact on broader financial conditions as a function of this explosive growth in public sector borrowing. That won't be the case as we move forward in time, 2025, 2026, and beyond. And so this final thing I'll say is, we've gone the sort of global private non-bank financial sector has gone from 36% of the marketable Treasury market to 54% currently. And then that was from late 2021 to today. And so you wonder why 10-year Treasury yields more than doubled since then. This is the reason. We the private sector, we the investors, We want units of return for the risk that we're taking in our portfolios. We need an ex ante yield to justify the speculating in the treasury market and capitalizing Uncle Sam. So that's number three, or sorry, number two. And then finally, number three, with going back to our initial discussion, things like yield curve control, keeping interest rates artificially deflated. And on that final point, artificial interest rate, the keeping interest rate artificially low. One of the things we've observed in our analysis that I think is going to become more sort of part of the, sort of broader investor lexicon, which is this concept that the bond market is not functioning properly. This is a bond market that has, even with, sort of fiscal, the U.S.'s unsustainable fiscal path being something that most investors are having conversations about, certainly in the recent months, we still have a very de minimis term premia in the bond market. If you look at the 10-year treasury, we're at 22 basis points wide off of a long-term average of about 150 basis points. A normal functioning healthy bond market will have about 150 basis points of term premium on the 10-year. And so you can make the case that as a function of the Fed's, the bloated size of the Fed's balance sheet and other, global dynamics that, I would argue in the context of, a multipolar world emerging will become less and less supportive. You can make the case that the 10-year treasury yield is about, 130, 140 basis points lower than it otherwise should be if we were in a normal, healthy, functioning, bond market that was really only dominated by market forces. You're talking about.
So it should be around 6% right now.
Yeah, just shy of 6%, 5.7% this morning.
And that's based upon a normal term premium. But how would you define? I don't think a lot of our viewers know what term premium really is or how it's calculated, or both.
Yeah, so the term premium is the excess return you get for taking illiquidity risk in the bond market. So if you just did this mathematically, you could roll over a 3-month T-bill for the number of times for each 3-month interval until you get to 10 years, and that will be one yield, and then the term premium will be the excess return on top of what you would otherwise get for rolling over short-term paper. And so what we found with what models like the ACM model from the Fed have found is that that illiquidity risk that investors that has come out of the bond market has really significantly come out of the bond market. And so, because you can make the case that the size of the Fed's balance sheet has been one of those causal factors to that, because it's constricted supply relative to what it otherwise would have been in terms of the impact it would have had on the broader investor portfolio. And so, going back to this mispricing in the bond market, if you had a 10-year treasury yield that was more appropriately priced with a more appropriate level of term premium in it at about 5.7%, you're talking about a 10-year TIPS break-even rate of about 3.6%. So that would suggest that core PCE inflation is somewhere around 3%. And this is something we've been.
So for people that don't know, the TIP is the Treasury Inflation Protected Security. Yeah. Basically, it floats with the rate of inflation. It's supposed to give you the net of inflation interest rate.
Exactly. And right now, you're only getting compensated for 237 basis points of inflation on a 10-year basis in the TIPS market. There's probably more, like if you were right on this sort of fourth turning dynamic really having significant economic and financial market consequences, then we are going to have a significantly higher level of inflation. And this is something we've been arguing our research for the better part of 3 years. We published our secular inflation model back in January 2022, and the key takeaway from this analysis was that the equilibrium level of inflation in the U.S. has essentially doubled. Now, doubled from a very low level. If you look at core PCE inflation, we were tracking at around 1.6% on an equilibrium basis in the prior decade. And our math, which takes the interpolated change of these normalized, the normalized change of interpolates the normalized change of these leading indicators and the coincident indicators of inflation back upon the underlying trend of the time series. And what we found is that we're now in a U.S. economy that has about 2.7 to 3.1% trend core PCE inflation. Now, that doesn't seem like a lot, but it is certainly a lot in the context of a Fed that has a stated 2% inflation target, which we would argue and have been arguing for over a year now, that the Fed has changed its inflation target. They are no longer trying to get the economy to a sustained 2% level of inflation. They are cutting the policy rate with core inflation in the 3.5% range. They're cutting the interest rates with super core inflation in the 3.5 to 4% range. It's our view that the Fed has acknowledged the higher equilibrium level of inflation and is still implementing an asymmetrically dovish reaction function as partially as a function of that. In our opinion,
Darius, I totally agree with you. And I also wanted to bring up something that you maybe just saw today, which was the latest services CPI. The last 3 months increased at a rate of 4.4%.
Yeah.
And I think you could argue that the services part of the economy that matters more. Certainly, I know you made that point repeatedly as far as the health of the economy. Don't worry about the manufacturing sector, focus on the service sector.
Yeah.
And actually, that number aligns very closely with my friend Vincent Delaware and his haircut inflation. I don't know if you've seen that, but he thinks that's one of the purest ways of measuring inflation. You get away from all the government manipulation, and that's running about 4.5%, almost identical to what the core services CPI is. Again, last 3 months annualized. So I know one of your core beliefs is that we are in the stickier inflation environment, right, and that we're not going to return to where 2% was, the Fed's target, and actually maybe even the ceiling. Now that's probably a floor, or perhaps the floor is even a little bit higher. So I'm very much in sync with what you're saying, and I think it's, just think about the implications for the Treasury market based on that. If inflation is really running more like 4, then the term premium is even more absurd.
100%. Completely agree. I mean, don't forget that part of the term premium calculation is the inflation risk premium. And the inflation risk premium is going to come from, upside surprises in sovereign debt, which we would argue is arguably the highest probability outcome we see as a function of the forward turning is an upside surprise in sovereign debt growth. And so, in our view, we have a strong belief that the bond market is mispriced. And it's how do we go from today's pricing to either getting this mispricing resolved, or what factors will cause the mispricing to persist? It's our belief that the Federal Reserve will continue to insert itself by, having a, sort of a de facto, positive revision to their inflation target, which then allows them to be more dovish at higher levels of inflation than they otherwise would be with the 2%, at a hard 2% mandate. Those are the types of choices that we think the Federal Reserve will make as a sort of lender of last resort, if you will, to the Treasury market to keep financial stability concerns at bay. Right, the Fed has a congressional dual mandate of price stability and maximum employment, but the reality is what we've learned in the last 30 years is that the only mandate that really matters to the Fed, the mandate that matters most, is preserving financial stability. And in our view, preserving financial stability starts and ends with maintaining smooth functioning in the Treasury market. And so we've seen the Treasury take explicit steps in recent quarters to maintain smooth functioning in the Treasury market. We've seen the Fed take explicit steps in recent quarters to maintain smooth functioning in the Treasury market. On the Treasury, we continue to see a high concentration of issuance. Really since the beginning of 2023, high concentration of issuance on the short end of the curve. Sort of keeping duration risk at bay in terms of the ultimate impact that would have on asset markets. And so we're likely to continue observing that kind of policy up until we get sometime in the middle of the middle of 2025, where their reverse repo facility balance has really essentially been tapped out. And so, concentrating the issuance on the bill segment won't really have as big of a sort of a vol depressing impact as it otherwise would. And once they start to issue on the longer end of the curve, I mean, I really don't know how you can survive that at these levels and these valuations in asset markets from the starting point of a positioning cycle that's pretty full, from the starting point of the liquidity cycle that could be moving in the wrong direction once we get in the second quarter of next year.
But the artificial interest rate suppression that they've been doing, although less in recent years, but you're basically saying they're going to be forced to do it again. And aren't the implications for that inflation will run even hotter in future years?
Yep, absolutely. And then that's one of the key takeaways in this forward turning analysis is that the choices the Fed and the choices that it starts with the demand for populism and the demand for more equality amongst the voter base, and how the voters very clearly very split on how to achieve those outcomes. But the reality is they're demanding those outcomes on both sides of the aisle, and that's exactly what going back to their initial discussion. That's why we have Donald Trump promising goodies to both the upper income and lower income part of the distribution. This is a new phenomenon in U.S. politics that you should expect to see persist over the long term. When you go back and you think about what could cause the inflation, it's obviously handouts, a positive shock from a fiscal support perspective, but it's also, again, the Fed's response to that. This is a Federal Reserve that has a choice to make. I mean, if you think about this from the perspective of game theory, what's the Fed, if it wants to preserve its own skin and its own credibility and legacy, would obviously take a hard line contractionary monetary policy stance in response to this. However, a Federal Reserve that wants to promote the maximum utility for the broader system has a role to play in becoming the lender, incrementally becoming the lender of last resort. And so how you think this
maybe even first resort.
And maybe even first resort. Absolutely. Although I would argue if you're the lender of first resort, then we have bigger problems, right? You're talking about potentially runaway inflation, a loss of U.S. dollar hegemony, et cetera. So there's a song and dance that the Fed needs to do well. You can't just say I'm going to outright monetize U.S. debts and deficits at an era where you're talking about the U.S.'s net international investment position has doubled in the past 5 years through 2023 to $20 trillion. If the Fed just came out and said we're going to monetize U.S. debt, that's a lot of dollar weakness that's ahead of us, and that could cause a significant problem in inflation that would actually make the Fed's monetization counterproductive, right? You can't monetize.
They'll never do that. And I think your idea that they're going to use, it's almost like a proxy war that we see in the Middle East. That in this case, the proxy monetizer is likely to be the banking system.
Correct.
Because if you said regulatory, let's call it encouragement.
Mm-hmm.
And that's kind of what they've done in certain instances already, but they're likely to do it. As you pointed out, the banking system overall has a relatively low level of treasuries compared to the past. Yep. But frankly, it was their exposure to longer treasuries that broke three big banks last year. So they're going to have some pretty good inducements to do that. But the Fed is amazingly clever at coming up with those when they need to.
Yeah, I call them the alphabet police. Anytime we have a new problem, they come out with a new alphabet soup of programs and policies. Like the BTFP. It's like, what was it? I heard somebody say something. Was that buy treasuries at any effing price or something like that? That's essentially right. What it is. Yeah. So look, I mean, I'm glad we can kind of have a joke and make light of some of these things because, we are, to your point, you made the point earlier, we are frogs in a pot being boiled alive of financial repression, monetary debasement, fiscal profligacy. These are things that are somewhat inevitable in the fourth turning, right? The system is already starting to come apart at the seams, and ultimately, the Federal Reserve is the institution with the most flexible balance sheet that will sort of, at the bare minimum, delay the inevitable crescendo and crisis that we're probably going to go through as Anglo-American society here in this fourth turning. And so, my former colleague Neil Howe, who's sort of the principal architect of this sort of line of thinking and has performed the research on this, looking backwards, hundreds and thousands of years. If you believe in the fourth turning, then it necessitates that you probably have to believe that these are all, obvious solutions. "Quote unquote" solutions is a very strong word there. These are solutions that policymakers will take to do that. And so the key takeaway is, as an investor, this goes back to the slide I was on earlier. As an investor, you got to understand that we're probably going to be an era that causes, structural bull markets and risk assets, hard assets, things that are further away from the treasury market from the perspective of, preserving value on a real basis. And that's not unlike, we always have bull markets and risk assets, so it's not new. But in a normal regime, you're talking about some, reasonable, "quote unquote" reasonably risk manageable cycles. You're talking about a 10%, correction in the stock market, or in a GFC or .com bust type event, 50% correction in the stock market. A 50% correction in the stock market in the context of what we're talking about could be normal in the context of a Federal Reserve that has to walk this very dangerous tightrope between not explicit monetization, but you do need to monetize, right? You have to, it's a hard dance I don't know. There is no right answer in terms of like what the appropriate path forward is. It's really just going to be a function of whatever the bond market needs from the Fed at any given time to tone down volatility. And at certain times that may actually be tightening monetary policy in order to preserve stability and smooth functioning of the bond market. Other times it may be expansionary monetary policy in order to, ensure that Uncle Sam gets capitalized in a way that doesn't crowd out the private sector, much like what we saw in the summer of 2023, and we're going to see in larger and larger size on a go-forward basis.
Darius, we're coming up on the time we need to let you go, but on this topic, I wanted to be sure, since you're talking about the importance of having hard assets to protect yourself in a period where we're being boiled with this monetary debasement and financial repression. So gold, and gold was, I mentioned this earlier, that was one of the things that you brought up in October, one of the assets that you felt was in a structural uptrend, and you were quite bullish on. It did pull back, unlike your great call on Bitcoin and the U.S. stock market, it did pull back hard post the election. Are your indicators now still bullish on gold, and would you look at this correction as a great buying opportunity?
Yeah, 100%. Yes, we are. We continue to. I mean, so we run a you may be familiar, David. We run a systematic trend following process for our retail investor clients that features gold as one of the core features of that process. 60% stocks, 30% gold, 10% Bitcoin. This, in our opinion, this is the counterpunch to what I think will become a sort of strategy that effectively confiscates money out of investors' pockets and puts it back in Uncle Sam's pocket, which is 60-40. I think the bond market, to borrow a phrase from Luke Groman, which I think is a brilliant phrase, the bond market will become certificates of confiscation. And ultimately, I think it's very important as an investor to find more credible, clever ways to get your clients' assets out of the bond market. And if you're going to be in fixed income securities, concentrate that on credit, concentrate that on mortgages where you can actually pick up a spread relative to the treasury market. Because to me, the treasury market is where we see the most risk and ultimately where we see the most opportunity as an investor who could be positioned in alternative asset classes like gold, like Bitcoin, and obviously stocks being the dominant driver there. So answering your question on gold, yeah, we are still 100% of our maximum exposure of 30% in gold. How we get to that maximum exposure, the target allocation in this systematic process is fixed at 30%. Gold has historically worked very well across all the different regimes that impact the target allocation in this program. And then gold remains bullish from the perspective of our volatility adjusted momentum signal, which controls the dynamic position sizing in this program. So we are still fully invested. This has been a phenomenal year of being, more or less fully invested across these asset classes. We recently pivoted to gold about a month ago, but we sort of decided to, hey, let's book our gains in bonds and rotate out of it, and probably for the last time, at least for quite a while.
Thank you, Darius, and I want to be respectful of your time because you do need to leave here momentarily. But first of all, I want to say that I am a subscriber, relatively new subscriber to your service at a premium level, and so I do see a lot of your work and your videos, and you're prolific in that regard, and obviously your command of all this data and the suite of indicators that has worked so well. And I know you pointed out that when you look at stocks or you look at Bitcoin or you look at gold, that the return that these asset classes have generated has come almost entirely. In some cases, I think in the case of Bitcoin, like over 100% of the return has come when your indicators are bullish. Oh, yeah. So you guys have done a great job. And how do people that want to learn more about your system, how do they track you?
I appreciate you, David. Thanks again for this opportunity, man. So definitely come check us out at 42macro.com. It's a really fun experience for folks who are just kicking the tires on us. But we also have a lot of educational resources available on our website as well. Specifically, our macro class is free and available to the public. 3-part, 3-hour class. If you want to get up to speed on all these indicators that we're watching, how we think about forecasting the business cycle, forecasting the liquidity cycle, the different indicators that we use to keep our clients on the right side of cyclical market risk, because that's not something we've talked much about today. Definitely come check us out at 42macro.com, and I'm also available on Twitter and LinkedIn. Twitter, Darius Dale 42, LinkedIn, Darius Dale. So I appreciate everyone who can come check us out.
All right. Well, there you go, everybody. And I'm going to stay on here to answer questions. I'm going to do my best to channel my inner Darius Dale, though it will be a very inadequate job, and I apologize for that. But we need to let you go, Darius. So thank you so much, and I'll be talking to you soon.
Yeah, thank you, and God bless, man. I appreciate you guys, man. Best of luck to each of you guys as well.
We always need luck in this game.
Amen. I appreciate it.
All right, everybody. You're off of mute. I see some familiar names up here. I'm sure there's going to be some questions.
Looks like we got Jeff Harbaugh. Go ahead.
Hey, Jeff.
Good morning. I'm really sorry I missed the first half of that. I'm going to beg and grovel for a replay if you're going to make them available.
Oh, yeah. We'll have a recording available for sure.
Great. Could you talk some more about what's going on in the short end of the Treasury curve? How much longer can they continue to emphasize T-bills as the amount that has to be refinanced goes up and the new debt comes into being? It feels like that is something that could lead to a bit of a crisis when it just overwhelms the willingness of the market to accept that.
You're absolutely right. And I think that's why particularly if you went back a few years when the long end of the Treasury market yields were very low. I mean, if you don't know, in the summer of 2020, the 10-year Treasury got down to a yield just barely above 0.5%. And of course, that was a time when households were madly terming out their debt. So they were, refinancing their mortgages, extending their mortgages. Corporate America was doing that aggressively. They were paying off older, higher yielding debt, issuing new debt at much lower yields and for longer maturities. You would have thought the federal government would have done the same thing, but they didn't. And I was very critical of Yellen's decision. Well, actually, initially it was Mnuchin, because Trump was still in office and Mnuchin was controlling the Treasury until early 2021. But they didn't do that. And Luke Gromen, who Darius brought up, and it's good to hear him recommend one of my favorites, but he believes it was because even then, there just wasn't much in the way of a bid for long-term Treasury debt. At this point, I'd say it's very apparent that's the case. I think that long end of the market is very fragile. There have been a number of disappointing Treasury auctions. I think at some point we could have a failed longer-term Treasury auction where they just have to pull the deal in. So they are being forced to issue at the short end. Now, a lot of people say, well, there's still plenty of foreign demand for Treasuries. And what they tend to look at is countries like the Cayman Islands, Luxembourg, the UK, which tend to be where the hedge funds are domiciled. So these hedge funds are buying large amounts of Treasuries, but they're all short. I mean, very few want to go long term for all the reasons that Darius articulated. So there's just not the pool of buyers out there, because in the old days, as Darius said, these foreign central banks were pretty much price insensitive. They would buy Treasuries almost irrespective of the yield, just because they had all these dollars from our massive trade deficits to recycle. But they're not recycling those into Treasuries anymore. And I've talked about this before, but the reserve asset of choice for foreign central banks has become gold. And that's why when people say, oh yeah, but American investors, they're not too wild about gold. They want to buy Bitcoin, whatever. Okay, that's true. And Bitcoin is a very attractive asset in a forthcoming type of era. But these foreign central banks have infinitely more buying power than U.S. retail or even U.S. institutions, and they're going after gold. And that's why I wanted to tease out that Darius still is bullish on gold, because that was, if you were to listen to his podcast, which is available, by the way, you can go and listen to that. I would encourage anybody that's now intrigued by Darius to go back and listen to the Macro Voices podcast he did last month with Eric Townsend. And as I said, it's free and available. And he was very, very firm that there was going to be a post-election rally in equities of Bitcoin, but he thought gold would continue to go up. And obviously gold was the one that went the other way, but he's still maintaining his bullish outlook on it. I think it's a great chance to come back in with gold and silver and also the miners. But as far as long Treasuries, I think they've got an acute problem. And, he's saying that he thinks the yield needs to be at 6%. Let's just assume that inflation is really running at 4%. And I think most people believe it's closer to that area. I think that's why Vincent Delawarde's haircut index is quite intriguing. So that would mean really, if with a 1.5 point premium on term premium, you probably should be, pretty much up there in that 6%, 5.5 to 6% zone right now on 10-year Treasuries. The problem is, if you got there, the economic negatives would be so powerful that it would, it could create a financial crisis. So that's why. That's the Fed, Jeff, doesn't want to let these long-term interest rates go to where they probably should be to attract normal buyers outside of the banks, particularly if the banks are in effect forced to buy Treasuries. And that's really what I think he believes is going to happen. It's what I believe is going to happen. And they'll probably do it with some very clever, like allowing them to pledge their Treasuries should they fall in price, allow them to pledge to the Fed at par. And that's kind of what they did in that bank bailout program that he was alluding to. The Fed has a lot of tools and they're very clever, but I think the Treasury market, like he said, he used the term that when I joined the financial industry in the late 70s, bonds were called certificates of confiscation. Soon thereafter, they went on a 40-year bull market. And people forgot that term, but that term is back. And I think you're going to hear it a lot more going forward. Okay, I'll quit rambling. Who else? Nobody's going to ask anything. I'll see if I had anything that I was going to bring up to him. So one of the things that I think is intriguing is this idea that all this liquidity that was created over the last year and a half could that spigot be at least partially turned off? And I thought Powell's comments last week were quite interesting because he's kind of done a 180. As Darius was alluding to, here we've got easing going on at a time of near record low unemployment, economy that's supposedly still growing at 3%, inflation, even officially above the Fed's target, kind of an odd time for the Fed to have done a 50 basis point cut. If you don't know, that's very rare. Then they followed up with another quarter point cut right after the election. But I think Powell's telling us that it's a different game now. And it could be that the Fed and the Treasury, at least until the Treasury is transferred over to whoever is going to be Trump's new Treasury Secretary, are going to be much less inclined to provide this excess of liquidity, which has been so friendly to asset prices. And if that's the case, so there's no love loss, obviously, between Powell and Trump. And if Powell's going to play hardball and feel like, okay, with all this fiscal stimulus that Trump is talking about, which, corporate tax cut down to 15%, no tax on tips, no tax on overtime, no tax on Social Security. I mean, these are cash giveaways. I mean, it's not a lot different than, the CARES Act, where people were being sent trillions of dollars. And he went through some of the numbers. I looked at David Stockman's research, and you could get his newsletter pretty easily. He does the best job of really crunching all these giveaways and indicating how expensive this is going to be. And if Jay Powell might say, hey, if you're going to do that stuff, good luck. I'm not going to be the one that finances it. At this point, that's just kind of a theory. But I think it's a theory worth considering because it would have very significant financial market implications if it's true. All right, did that trigger any questions or comments?
I have one. Let's talk about market concentration. So I think the US now represents something like 70% of global stock market cap. And do you think that that's sustainable?
No. Short term, yeah, it could keep happening, and it's gone further than I thought it would. Could it go to 80? I guess so, but I think we're very, very stretched in terms of that. And of course, valuations in the U.S. are way higher than they are overseas. There's a lot of very inexpensive markets, and I think particularly if we get more trouble in the bond market. And since the Fed cut back in September, the yield on the 10-year Treasury, I haven't actually checked it this morning, so somebody might correct me. I might be a little bit off, but it was up 80 basis points, 0.8% from when the Fed cut. That's a big increase. So if those rates do keep going up, I think that's going to be the trigger for the next correction. Having said that, we're in a period where the U.S. stock market typically does well, kind of coming to that Santa Claus rally period. And we've had probably a lot of front running of that. And as you know, last week, the market traded poorly in the second half of the week. And we got back to basically where it was on Wednesday morning after the election. So a lot of that post-election euphoria has worn off. It could be just a normal correction, but yeah, I think in general, if you're looking to make money in equities, good money over the next 5 to 10 years, you're probably going to want to be looking outside of the U.S., with the exception of perhaps some of the hard asset producers, and gold miners are really cheap, and oil and gas stocks are really cheap. Pretty much all the commodity producing stocks are very underpriced, which in a fourth turning, those are usually where you want to be. Typically, if you're in a period of higher and rising inflation, traditional equities struggle. I mean, certainly look at the 1970s for a good example of that. And yet the hard asset stocks in that decade did very well, though with some sharp pullbacks, such as we've seen here recently. Okay.
Looks like we got one from Alan Jordheim.
Go for it, Al.
Hey, good morning.
Good morning.
Based on the discussion on the fourth turning, talking about increasing inflation or possible more inflation coming, what's your thoughts on inflation-adjusted Treasury bonds, the I bonds?
Yeah, they make a lot more sense than the traditional bonds. So yes, I think they're logical. You got to be a little bit careful that they are bonds. And as a result, you can do fine on the inflation adjustment part of it, but actually lose money on the interest rate part if yields are rising. Now, there's a way to do it, apparently, and maybe an ETF on it where you just do inflation break-evens, which is kind of a futures market play where you're basically just isolating the inflation protection part of it and eliminating the bond exposure. So that's one way to do it. You could probably go with shorter maturities. I think with the shorter maturities, you get less of an inflation adjustment. But that's, to be honest with you, that's an area that we haven't done hardly anything for clients over the years. We've tended to focus more on corporate debt, or like Darius was even mentioning, mortgage-backed debt. I think you could see a situation where mortgage-backed debt, say government mortgages, actually trade through the treasury yield. It's going to take years for that to happen, but I think it could happen. And the reason is that you've got a better credit in effect with a mortgage bond, because these mortgage-backed debt actually have, millions of underlying mortgages, people paying their mortgages, which the default rates are very, very low. And if there is a default, then the government picks up the tab. And so it's basically a double barrel bond. You've got a double credit there. And that's why I think ultimately you can see mortgage debt at a lower yield. I think that's going to happen with high grade corporate debt, by the way, that it's going to trade at a lower yield than treasuries. And if you think that's an outrageous statement, I just listened to an interview with Jeff Gundlach, who's considered to be the new king of bonds. And that's exactly what he said. And he pointed out that when he first got into the business, kind of when I did, early 80s, that IBM debt was trading at a lower yield than U.S. treasuries, because that was a time when U.S. debts and deficits had exploded. But of course, nothing like we're dealing with today. So I do agree, treasuries are in a multi-decade bear market. There's going to be rallies, and we could be looking at we could be on the cusp of another one coming up here soon. With as much as they've sold off, and if the economy starts to look recessionary. But the problem that you've got with long-term treasuries is that if there is a recession, the deficits are going to erupt, and as a result, the issuance will be truly enormous. I mean, it already is, but it's going to be enormous, squared or cubed. Thanks, Alan. Anybody else?
Looks like that
David,
might be it.
we have one from Robert here. Does it make sense to buy puts on bond ETFs?
Yes, but I would probably try to do that when they're overbought rather than oversold. So maybe this isn't the ideal time. But I will say that really weak markets can stay oversold and the prices can keep going lower. And that's kind of what we've been seeing here with bonds recently, which I think just speaks to their inherent fragility. But still, buying puts, that's a pretty aggressive move. So you probably want to do that when the stars are better aligned. So, going back to when treasury yields were 3.6% a few months ago, back in the late summer, and there was quite a bit of optimism on bonds, and that's probably when you want to do that. So even in a bear market, there are powerful counter trend rallies, and there is, I think, a fair argument to be made, though Darius would disagree with this, that the economy is weakening, and I do worry. So in a weakening economy, that tends to lead to bond rallies, particularly if it's not a severe recession that causes that issuance explosion that I was referring to earlier. But yeah, it could be, to the point kind of I was making about Jay Powell, and that perhaps he's not as inclined, and the Treasury's not as inclined to inject all this liquidity to make things look better going into the election. Now that the red sweep has happened, they don't have that motivation. If they did, I kind of think they did, but a lot of people would disagree with it. But it's certainly what happened, regardless of what the motivation was. And that could be true with inflation, that you're not going to have, or the economy rather, but inflation and the economy, you're not going to have as much of an impetus or desire to spin things so that the economy looks really healthy. Because as you know, a lot of the revisions that have come out after the initial positive releases of economic data have been downward, almost all of them. And so I know that there's people like David Rosenberg, Danielle DiMartino Booth, very smart strategists that say, hey, look, this economy is still looking quite weak and has been kind of dolled up to appear stronger than it really is. So, that maybe that will change as well, which could trigger a near-term bond rally. If that happens, that's, I think, when you might want to look at on the more negative side of the bond market, especially with something like puts, because you got to be right in a relatively short period of time when you're buy a put or a call. Anybody else?
Jeff Harbaugh looks like has another one.
If I'm allowed
Yeah.
to, I have,
Sure.
David, I have watched the dollar strengthen again, and I have watched some of the foreign ETFs that are dividend yielding go down. And I'm thinking it's a good time to put some more money in those things, maybe more than I usually would, because I believe that this is no longer a matter of no risk in the US and a lot of risk in foreign markets. What's your take on that?
On the dollar specifically and the rally it's had?
Well, on the relative risk between the United States and some of these international funds that are focused on dividends and yields in other countries.
Yeah, I think in general, the risks are lower overseas and that the valuations are almost, in almost all cases, India being an exception, much more attractive than they are in the US. And these things go in cycles. I mean, it was early, like 2011, 2012, the early part of the last decade, when international investing was all the rage. And people didn't want to touch US stocks. And they were trading, you know, the Dow was trading at something like 11 times earnings. And I think the top 10 stocks on the S&P were kind of in that range, 11 to 12. I mean, that's Microsoft, believe it or not, was trading at a low double-digit PE back then, as was Apple. It's hard to believe how cheap U.S. stocks were back then, and of course, radically different today. And so, yeah, I think that's why Warren Buffett's got over $300 billion in cash. And he's got some foreign exposure, but even there, he's being pretty careful. I think as far as the dollar goes, because obviously the dollar has a lot to do with that, particularly when it comes to foreign bonds. And foreign bonds have been soft here, at least lately. We like emerging market debt a lot and would buy it on weakness. But I think it's odd to have the dollar going up along with Bitcoin. I mean, Bitcoin is meant to be like a replacement for fiat currency. So that's kind of bizarre. But, you know, there's just a lot of kind of Trump-phoria out there right now. And so the dollar is getting lifted by that. But, you know, as Darius was pointing out, this is really kind of unprecedented to have a president-elect who wants to do populism for the rich and the poor, for basically everybody. And I don't think that's bullish for the dollar at all. So there's multiple ways to express a more bearish view of the dollar. Gold at this point, I think, is a timely one because it's pulled back. Silver's pulled back. Palladium's pulled back. That's having a big day today. Uranium was really depressed here like a week ago, but it's just gone nuts over the last literally, 6 or 7 trading days. And so I think anti-dollar plays are, in whatever way you want to express it, are probably the way to go. And I have a tendency to like the ones that have been lagging more recently. Thanks, Jeff, for that.
Yep, thank you.
Well, we're a little bit after the hour, so unless somebody's got a pressing question, and if you do and you don't want to ask it here, just feel free to send us an email. So thank you, everybody, for your time, and I hope you found Darius as interesting as I described him. I think he did. I mean, he is just, you listen to his podcast. Again, feel free, or I encourage you to go listen to that when he did, the full one he did, because that way we'll get about an hour of him. And he talked about a lot of different topics that we didn't cover today. So go to Macro Voices and check that one out. We're not supposed to recommend our competitors, but I do it all the time. Miracle on 34th Street type of approach to our business. All right, everybody. Thank you very much. Have a good day. Have a good week.
Thanks, everyone.